1031 exchanges are one of the most powerful tools available to investors today, but they're also one of the most misunderstood. This process allows investors to defer the taxes on the capital gains of the sale of an investment property. Hi, I'm David with Premier Mortgage Advisors and your host today as we walk through the 1031 exchange process from start to finish. Join me and our special guest, Patrick Noonan with IPX 1031, as he shares over a decade of experience so that you get the most out of your 1031 exchange. And who knows, what you learn here today could save you hundreds of thousands in taxes. Let's dive in. Welcome to Premier Mortgage Advisors. I am excited to introduce our 1031 exchange partner, Patrick Noonan. Patrick, thank you so much for taking time to be here with us.
Thank you, David. It's really great to be here. I appreciate it.
Fantastic. Well, I guess let's dive right in.
Okay.
Tell us a little about yourself, a little about your company and what we do.
Sure. So I work for a company called Investment Property Exchange Services, IPX 1031 for short. I've been working with them for about 10 years now. We're the largest qualified intermediary in the country. We do, our little region here in Dallas, we probably do about 200 to 400 exchanges a month, just depending on the market.
Wow.
So that would be in Texas, Oklahoma, Louisiana, Arkansas, and that's our little region, right? So that's where we focus on. However, we do 1031 exchanges all over the country. So when people are exchanging from California to Texas, which seems to be happening a lot, we're doing those. So we can exchange freely anywhere.
You hit the nail right on the head. We have a lot of money coming to Texas, a lot of investors moving from other states moving into Texas, not only for the tax benefits, but for the growth coming in here to the southern sector.
Right, yeah, when you consider that you could cash flow much more easily in the Metroplex or anywhere in Texas or Oklahoma, it's not a hard decision for people to make.
Yeah, absolutely. I love it. So a ton of experience, and we're excited to bring you that to our viewers. And hopefully you guys learned something. So we'll take it from the beginning, right? Very foundational level, right? We'll kind of 1031 Exchange 101 class,
sure.
Right?
Yeah, so let's talk about what we're trying to accomplish when we do a 1031. So 1031 is a IRS tax code, right? It helps people to defer the tax that they would normally pay when they sell investment property. And you do that by, number one rule of 1031, open an exchange before the close of escrow of the property. In most cases, you're selling.
Right.
And a reverse exchange is before you close on the property you're purchasing. That's the number one thing. I teach classes on this all the time, and then I'll have people that even attended the class, and they'll call me a week after they close and say, hey, I got a check, I want to do a 1031.
Oh, wow.
It breaks my heart because we can't do anything for them at that point. So if you're representing your clients and you're talking to them, make sure that if they have an investment property that they know that they have to take some action on their own before the closing happens. And they could call me or some of my counterparts all over the country, and we can walk them through the process. So essentially, the first step is just getting that exchange open.
Yep.
Now, when we're talking about getting to a 100% tax deferral, it means that you're going to be selling property and then you're going to be reinvesting in new investment property held for investment or productive use in a trade or business. So property type is really broad, okay? So you could sell a piece of land and buy rent houses or retail or office, industrial, warehouse, just about any kind of property held for investment or productive use in a trade or business.
Okay.
Yeah.
Interesting. So staying on that for a second, if I
Sure.
sell a rental property that I have and I want to move into, say, a strip mall or a commercial, that would qualify under the 1031 exchange.
Absolutely, yeah. You can even exchange out of and into gas and oil rights. So
Interesting.
Water rights, yeah. So any kind of a real property right, as long as it's held for investment, can be held or exchanged for any other.
Wow, interesting.
Yeah,
Interesting.
yeah.
I was not aware that you could go from commercial to residential.
Yeah.
There's the kind of the buzzword in 1031 is a like kind exchange, right?
Right.
So kind of the interpretation of that has always been residential investment to residential investment.
That's a common misconception. There's a lot of information out there that is kind of off base a little bit when it comes to 1031. So you really have to rely on somebody who knows the rules inside and out, right?
Yes.
So talk to a qualified intermediary like myself or somebody in our industry that's got experience. you know, when you're considering the broad range of properties, it could get people out of one property type and into
Hmm.
another and change their entire, investment portfolio. So I see folks that have, let's say, 20 or 100 rental properties, right?
Right.
And they may want to combine those in an exchange to go buy one multifamily, right? So you combine multiple properties in an exchange to go
Hmm.
buy one or several, and you could also sell several and combine into one. So there's that flexibility.
So where in the mortgage process does the 1031 agent fall?
The earlier the better, that they
Right.
could engage somebody like myself to, walk them through. There's a bunch of different questions that we could ask to find out, one, is this going to be a benefit for them,
Right.
right? Because there's a few things you have to know in order to determine what your benefit will be.
Hmm.
Okay, so the first thing is the adjusted tax basis in the property.
Right.
Now, I do exchanges for, 100,000 up to, 800, $900 million, right?
Right.
And nobody knows what that basis is. So it doesn't matter the
Right.
sophistication. It's just one of those things that you really want to be aware of, because that helps you determine what your tax liability is going to be. Okay.
Gotcha.
So it's a pretty simple formula. It's what you bought the property for. You
Hmm.
subtract depreciation, which lowers your basis, and you
Right.
add capitalized improvements, which increases your
Hmm.
basis. And it can change every year. So the easiest way to find that out would be to ask your tax advisor, your CPA, or
Hmm.
accountant. If you do your own taxes, you would look at your prior year's tax return,
Right.
and you could find that number. And
Okay.
that's where we start to determine what that tax liability will be. So you're taxed on every dollar that you earn on the sale of investment property over that basis up to your sales price,
Hmm.
minus qualified closing costs like real estate commission, title insurance premium, and escrow fees.
Gotcha.
So that would be your target replacement value. Okay, so you got
Right.
your basis and your target replacement value.
Okay.
You could still benefit from doing an exchange even if you don't hit your target replacement value. You may have a partial exchange, but
Hmm.
you want to be sure that you buy substantially over that basis so that you start
Hmm.
to defer more tax. The more you reinvest, the higher your benefit is going to be.
Got it. Got it. So this isn't something where you're halfway through the transaction and you think to yourself, "Oh, I should probably do a 1031 exchange."
That would
Right?
be, yeah, that would be tragic. In fact, I get calls all the time from people that say, "Hey, I just closed on my property yesterday and I heard about 1031 exchange. I would like to
Mm.
do one." Well, in the eyes of the IRS, the taxable event's already occurred.
Mm.
So I can't do anything for those people. Can't go back in
Yeah.
time. So it's incumbent, upon the actual taxpayer themselves to really take action.
Hmm.
But it helps when a mortgage person or
Right.
a escrow person or a CPA or even a realtor who's knowledgeable about 1031 and sees that they're selling an investment property
Hmm.
mentions that they may want to consider doing a 1031 exchange.
Yep. Absolutely. Absolutely. So thinking through the lens of the mortgage world, right? We
Hmm.
see investors that are either selling their property, moving to another investment, or even selling their property and splitting it into two. So by the time we get involved, we're doing pre-approvals and pre-qualifications. Ideally, you'd want to be involved prior to that.
Yes, there's a number of reasons why earlier in the game the better.
Right.
There's partnership issues,
Hmm.
LLCs, split ups, people that want to take cash. Um, the more educated that people are in advance,
Hmm.
the more they can determine the outcome of their exchange and
Got
their
it.
loan, right?
Yeah.
They want to make sure that they're getting an investment property loan for a 1031 exchange. It's really important because everything kind of all ships must sail in the same
Hmm.
direction.
Yep.
So if you're doing an investment property sale and you're going to be buying an investment property, it's important to do an investment property loan.
Got it. Absolutely. So putting that into real life application, right? We
Hmm.
talked about this off camera. Was a client of mine. We received information from the CPA. The CPA stated that we could produce a second home loan and get better pricing for the customer on their loan instead of doing an investment property loan to apply for the 1031 exchange. Now, in that scenario, we talked off camera, that's not okay. And we found out the hard way the day before closing
Yeah.
that that is not okay,
Well, at
right?
least you found out, right? Because
Right.
I'm certain that this kind of stuff happens, and it's probably through the best intentions of the loan officer
Hmm.
or the CPA trying to get the best rate for their customer,
Right.
right? But it's vital that they have the investment property loan because it puts them in a position where they're either committing loan fraud or
Right.
tax fraud by representing it as a second home.
Right.
So you don't want to do that. It puts you in a bad position down the road.
Yeah. So can you give us a brief overview of start to finish from opening your exchange account all the way down to closing and signing everything?
Sure. So the steps of a 1031 exchange would begin with getting under contract on the property you sell, right?
Yeah.
Then you would want to make sure that you reach out to a qualified intermediary and provide them with the information they need to open your exchange, which is pretty basic. It's the contract, the title commitment, and the contact information for the escrow officer. And then typically what I'll do is I'll reach out to an escrow officer, ask for a copy of the contract and commitment, and let them know that their customer is doing a 1031. Once they send the contract and commitment, we draft and circulate exchange documents that must be signed on or before the day you close escrow. And that's when all of the deadlines begin, that close of escrow. So if you think of a 1031 as having a lifespan of 180 calendar days, it begins on the day you close escrow. The first 45 days of that 180 are the identification period. So we will provide a form out of like courtesy for our customers to provide that identification, and they'll then get that to us prior to midnight on day 45. As long as we get that, then they'll exchange will continue on for the remaining 135 days that they'll have to close on the property from that list.
Got it.
Now you'll find that there's rules within rules with 1031. So the first set of rules that an exchanger is going to probably confront and have a lot of questions about is the identification rules.
Right.
So you've got three identifications rules with 1031 exchange. The first is the three property rule. And it says you can identify up to three properties with no concern over their aggregate fair market value. So let's just use a sale price of $100,000. I'm selling my rent house for $100,000. I'm going to go out and I'm going to identify three properties or less. Their combined value could be 100,000, a million, a billion, a trillion. It doesn't matter, right? But the second rule is the 200% rule. And it says if you identify more than three properties and their combined value exceeds twice what you've sold your property for, then you don't have a valid exchange. So you trigger a cap.
Interesting.
Yeah, so that's based on your sales price. So same example, if I sell for $100,000 and I identified four properties or 10 or 20 or 100, as long as the combined value of those properties doesn't exceed $200,000, you're okay.
Interesting.
Yeah. So that one
Okay.
can be, it's confusing. And you know, when people are doing a 1031 exchange, it's like learning a new language. There's just a whole vocabulary. There's all these deadlines, so
Right.
people can get a little bit stressed out. And it's important that they know that they've got somebody that they can call and walk through that identification with, because it's super important that it's done correctly. If you exceed the three property rule and the 200% rule, you can still have a valid exchange if you close on 95% of what you identify.
Okay.
Not to be relied on very often, but it does have a use for specific circumstances. So let's say you sell, a big warehouse, and it's $1 million you're selling it for. And you go out and you find a warehouse complex that has 8 units, and you're going to buy that for $10 million. Okay. Well, you exceeded the three property rule, and you're buying it for 10 million, so you've exceeded the 200% rule, but you're going to close on 100% or nothing, right? It's one seller,
Interesting.
one contract. So in that case, you could rely on that 95% exception. Doesn't come up a lot, but it's important to know that if you have more than two sellers, you probably wouldn't want to rely on it, just because
Gotcha.
chances of something falling out are pretty high.
Pretty right.
Yeah.
You know, thinking about this concept of moving into like kind properties, right? So say if I have a larger exchange, I did really well on a property, I'm going to net out say 500,000, right? Is it possible to split into say another residential property and then another part of that same 500 into a commercial property?
Yes,
And diversify across the board.
absolutely. You could do that, and people do that all the time. So you can again, you're kind of broadening your portfolio of real estate.
Right.
You've got different, because just like any kind of a market, right? Multifamily has a season,
Hmm.
rent houses have a season, office has a season. So you can kind of spread your property types by doing an exchange and leveraging that equity from one or several properties to one or several properties.
Yeah, absolutely. Thinking of the loan process along with that, right? By the time we've identified our new property is typically where your loan officer gets involved,
Yeah,
right?
exactly.
Identifying and how much are we going to need to bridge the gap between your exchange funds and the additional funds needed to acquire the property.
In order to get to a 100% tax deferral, you really have to do three things. And that's buy equal to or greater than what you sold for, minus qualified closing costs. Use all your cash first towards the purchase of a new property, and replace the debt with equal or greater debt on the property or properties you buy. Okay,
Interesting.
so
Okay.
that's where that component of knowing what that cash component is that's going out towards the purchase of the new property is.
Right.
Especially if you're buying one property and you're just looking to go exactly at like what you sold for. Now it's more frequently that people are going to buy over what they sold for, which is
Right.
perfectly fine. And sometimes they buy for less than what they sold for, and that can be okay. But you don't want to buy for so much less than what you sold for that you get below your adjusted basis, because then you eliminate the benefit of a 1031.
Interesting. So thinking of, and this was another client that I had previously worked with IPX as well. There he had purchased a duplex a long time ago in the heart of Dallas in Oak Cliff area, and he split his 1031 exchange to two different properties.
Right.
Right, and both of those properties aggregate together were 800,000.
Okay.
His exchange was 650. So because he exchanged for a higher valuation, that a higher
Purchase price.
purchase
but
price,
Yeah.
right? That exchange is perfectly fine.
Absolutely.
But had he found one that was say 300,000, it would be not
Yeah.
qualified.
So and that's it's not fatal to the exchange if you don't hit the marks, right?
Okay.
But you would have what's called boot, and boot is just tax liability that you incur with an exchange. So let's say you had the same guy who sold the $800,000 property. He bought one for $400,000 and one for $300,000.
Okay.
Well, he'd have potentially tax liability on that $100,000 that he was below what he sold for.
Gotcha.
Okay.
Even though he used all of his exchange funds, because the valuation of the exchanged properties was under
less, yes.
where he sold. Interesting.
Yeah, and there's different ways you can create boots. So one would be pulling cash out of an exchange. So you can do that. It's called making a reservation of proceeds at the closing of your sale. It's really the only time you can direct funds with a 1031. You would tell the escrow officer and your qualified intermediary, hey, look, I'm selling this property, for $800,000, and I want to pull $100,000 out to, pay off bills or go on a
Sure.
trip or whatever. So you take that $100,000 as a reservation of proceeds at the closing of your sale. Now you know that that's taxable, right? So
Right.
that's taxable boot. So you're going to pay your taxes at your capital gain rate, which is determined by your adjusted gross income. So as long as you're clear on that amount is going to be taxable, you're good to go. And then,
Okay.
that actually does also lower your target replacement value, because you're going to be taxed on that anyway, right? So it lowers that target replacement value by the amount of cash you take.
Gotcha.
It gets a little bit
Yeah, kind of into the weeds a little bit, right?
Yeah.
There's this broad generalization that you hear all the time, especially on social media and different outlets, that if you take any money,
It's
it-
fatal
it's
to the
all
exchange,
dead, right?
Yeah. And like I said, there's common misconceptions. One is I have to buy exactly what I sold for.
Right.
The other is if I don't buy for equal to or greater, I get no benefit from doing a 1031, and that's not necessarily true. You could have a partial tax deferral. We do partial exchanges frequently, and that could be caused by pulling cash out, buying for less than what you sell for, or receiving not like kind property. So let's say you sell a rent house on a lake, and it's selling for $100,000, and you go down the lake a little further to get another lake house that you're going to have for a rental, and it's $100,000 too, but it has a $20,000 boat. Well, you'll defer on the 80,000 of real estate, but you'll pay tax on the $20,000 boat. So the boat is booted.
Interesting. Interesting.
Yeah.
Okay, because that happens actually quite a bit. People sell their lake house and they're selling the jet skis in the dock and the boat in the dock along with the property.
Sure,
It's
yeah.
non-real estate items.
Yeah, and then we were talking about more, like let's talk about a hotel or something like that where there's
Right.
furniture or when somebody's selling a convenience store where there's going to be inventory and things like that. Those have to be excluded from the exchange. So you want to be sure that when you're doing your contracts, you're representing the value of the real estate in the contract so that you're clear on what you're exchanging.
You mentioned a little bit earlier about a reverse 1031.
Sure.
What is that? How does it function?
Okay, so a reverse 1031 would be required when you're going to buy the property you want to buy, your replacement property, prior to closing on the property you're selling or your relinquished property. Now, they're a little bit more complicated. They do require a longer time to set up. One is we need to make sure to form an LLC that's going to be referred to as an exchange accommodating title holder, whose member would be one of our companies, in this case, National Safe Harbor. The exchanger, the taxpayer, would be taken on as a manager of that LLC. Then the taxpayer would loan the money that it needs to that LLC with that third party on title, and the lender would have to be okay with lending to that structure too. So it's imperative that when you're doing a reverse exchange that you bring that to the attention of your loan officer well in advance, because they're going to want to get that letter, like we have a non-recourse letter that we'll provide. They're going to want to get that in front of their underwriter to make sure that they'll loan to that structure. And as long as we get that signed off on, then we can proceed with the loan to the LLC along with the cash that the taxpayer brings to go forward and buy their replacement property and close on it first. And then they have 180 days to sell their relinquished property, right? And
Interesting.
at that point, when that property is sold, they pay themselves back or even pay off the loan if they've got, all cash, let's say.
Mm-hmm.
So there's different outcomes on that. And essentially, once that property sells, or 180 days later, if they don't sell a property, we step out of that membership position, and then they would take our place in that LLC.
Interesting. Interesting. So that's very much the timing of exchanging the property, of selling the relinquished property and acquiring the replacement property.
It's just the opposite. So it's replacement first, then relinquished in a reverse. So you're
Okay.
buying your property before you're selling your relinquished.
Interesting.
Yeah.
Interesting.
And, lately that's been on the rise. There's been a big demand for reverse exchanges, and I think it's because people are out there looking for properties.
Mm-hmm.
They know they've got a property that they want to sell, but they want to find the property that they want to buy first.
Right.
I think that's driven by, people kind of been sitting on the sidelines.
Sure.
And now that rates are improving, they're anticipating that they can get a good rate when they, buy their property. And then they go forward and start the process.
Gotcha. Interesting. So in a reverse, thinking of the mortgage world, we would want to identify the relinquished property while we're purchasing the exchange property.
Well, just like with a standard exchange, it all begins on that closing date. You have 180 days to complete it. The first 45 days, the taxpayer has to identify what they're going to sell instead of what they're going to buy. Now, you're going to want to let the loan officer know that you're doing a reverse exchange, because they're going to have to make the loan to the LLC that's going to go buy the property.
Got it.
So that's where it gets a little bit complicated. And those are the kinds of things that can take time. That's why we suggest, if it is a reverse situation, that you reach out, as much in advance as you can, because just the process of establishing a reverse takes longer.
Right.
And then again, getting back to, there's a lot of potential questions that people will have about a 1031 and what they can do and what they can't do. Ownership issues, like how many people own the property, how they own the property. All of those things are important to discuss with a qualified intermediary in advance, so that they can give you guidance if you need to do a partnership split or something along those lines. And it's every week I send out a partnership split email, right? Because we've got 4 guys that own an LLC that has a property, and maybe they don't get along, or maybe they're just wanting to go in different directions, and it requires an attorney. So we refer out to an attorney that can help them with that.
Awesome. And one of the 1031 exchanges that I've run into, but we haven't talked about, is an improvement exchange.
Yeah, yeah. So improvement exchanges are the same structure as a reverse. They're
Okay.
part of a family of transactions we refer to in our industry as parking transactions, where we're parking title to a property.
Okay.
Okay. So the same requirement where we create an LLC that's going to be referred to as an exchange accommodating title holder LLC. The
Hmm.
member is one of our companies in this case called National Safe Harbor. The taxpayer is taken on as the manager. You loan the money that now this can be done as a forward exchange or a reverse exchange. Let's talk
Okay.
about it like it's a forward exchange. In other
Okay.
words, I've sold my relinquished property. I've found a property I want to buy and improve using 1031 dollars, tax deferred
Hmm.
dollars. So I'm going to do a build to suit exchange. We create the LLC. You loan the LLC the money it needs to buy the property and improve it, and you also make the loan to the LLC.
Awesome.
You acquire the property you want to buy, and then you start making improvements as fast as you can. So you have to make those
Right.
improvements, and you can only pay for improvements once they're in place. So it can be a challenge when you've got 180 days from the first closing to acquire and improve that property, because once that 180 days is up, we step out
Hmm.
again of that LLC ownership position, and the taxpayer would take our place, and the exchange is complete. Now,
Okay.
they get the benefit of every tax deferred dollars that they spend towards the improvement of the property. So let's say you sell a property for 500,000 and you find a building that you want to improve and it's only 300,000 and you want to use the other $200,000 to make improvements on it.
Hmm.
So from the day you close on your, let's say in a standard exchange, you close on your sale, you have your reverse exchange accommodating title holder LLC in place to go forward and buy the property you want to buy and improve. So
Right.
that ideally it's going to close the next day.
Hmm.
So you close on that purchase. You've got all your crews and your permits and everything standing by and
Right.
ready, and you're just starting to get people hitting the ground, making those improvements, and you're paying your subcontractors off with draws. It's kind of like a construction loan,
Right.
and you pay for those as they get done. And let's say your target replacement value is 500,000. You bought the property for 300. You get the benefit of that, and you
Right.
get. Let's say you don't get all the way there. Let's say instead of getting that $200,000 of improvement done, you only get $100,000 of the improvement done.
Okay.
Well, you would just have boot on that difference again. So you'd have
Interesting.
$100,000 of taxable gain.
Interesting. So in the other sense, we think of wanting to get the repairs and improvements done for the least expensive possible. But in this case, the target is to use as much money as you can for the tax benefit.
That's right. Yeah. Every dollar that you spend is a tax deferred dollar on those improvements. So, yeah, you really want to maximize your time and have, if before the supply chain shortages and all the demand for construction crews and things like that we're looking at now, they're a little bit easier to get done. I think it's turning
Yep.
around now. Some of these things are becoming more readily available, materials and crews and things like that. But you really want to be organized when you're talking about doing a built to suit exchange. You want to be able to, like I said, if you could close on your sale on Monday, close on your purchase on Tuesday, and hit the ground on Wednesday with your crews making
Mhm.
improvements, that would be the ideal scenario.
Awesome. So for some of our more ambitious investors, can we would we be able to have an improvement exchange on multiple identified properties?
Yeah. Now, an improvement exchange and a reverse exchange, they're a little bit more, they're a lot more expensive than a standard exchange, right?
Right.
With a regular exchange, you're looking at under $2,000 on average. When you're talking about doing a reverse or an improvement exchange, they start around $6,000 and go up from there.
Wow.
So, first thing you want to take a look at is what is the tax liability that I'm going to defer with the amount
Hmm.
of improvements I'm going to make. If it's not substantial enough to really warrant that fee, you probably don't, you just want to take care
Right.
of it outside of the exchange. But when we're talking about doing multiple properties at the same time, it can get pretty pricey.
Right. Okay, interesting. So you've mentioned a couple times the relationship between your CPA, your attorney, the exchange agent, and myself, the loan officer,
Right?
right? So obviously we're not all sitting in the same room talking about how to do this, right? So
Yeah.
walk us through how that relationship works inside the time frame that we have and what the communication looks like.
Sure. So, I'd say the majority of our customers um, have probably an accountant or a CPA, not necessarily a real estate attorney. More than likely, they're going to have a mortgage broker and a
Right.
realtor. The way I kind of like a everybody come to the party.
Yeah,
So
absolutely.
on my email threads and when I talk to my customers, I try to get the contact information for all of their, people that they rely on to get
Mhm.
information, attorneys, CPAs, and mortgage guys and realtors, so that we can work from a common thread, going from the
Mhm.
beginning of the exchange right to the end. And when
Love it.
anybody has any input, they can always jump in. We can easily contact each other if there's something that we want to make sure that the other party knows about.
Mhm.
So, when I get people referred to me, it's usually going to be coming from a CPA
Right.
or a realtor or an attorney, and so that's usually the beginning, right? And
Mm.
then once I talk to the taxpayer themselves, they may have a broker, and this whole team kind of starts to evolve. Now, when I get exchangers who don't have a tax advisor or CPA or real estate attorney, we strongly recommend that you get one. If you've got investment property, you're probably at the point where you need a CPA to be doing your taxes because you don't know what you might be leaving on the table.
Our next guest on the podcast is a trust and estates attorney who specializes in succession planning. Right. So thinking of the 1031 exchange process, I know it's very it's a short-term transaction relative to trust and estates. But how do you work with trust and estates attorneys to help them transition to the next season in their lives?
Absolutely. Now that's a really good thing you brought up, because a lot of the customers that I will have calling in, maybe planning for retirement, or they're planning for their next generation and inheritance and things like that, and they could preserve that equity that they have in a property if they're let's say they're considering selling. Here's what I get a lot: farm and ranch people. Okay, so I'm
Yep.
selling my ranch and I've got 5 kids. The 5 kids don't get along at all.
Yep.
So I want to take control over their inheritance on their behalf, so that they don't waste a lot of time and money on legal fees arguing amongst each other.
Mhm.
So what I'll do is I'll sell my ranch, and then I may go out as the taxpayer, and I may buy 5 ranchettes, right?
Mhm.
And then in my will, each one of my heirs will inherit one of those ranchettes. Okay, so now
Interesting.
everybody's on an even playing field, and I've preserved my equity that I have in my big ranch by going out and buying these 5 ranches.
Right.
So there's a couple of benefits there. One is it's the inclination of folks to gift property to their heirs before they pass.
Right.
Well, it's important to know that when you gift somebody a property, you're also giving them the tax basis in that property. So the tax liability that you have, they're going to have. Whereas if you pass away and they inherit the property, they get what it's called a step up in basis to the fair market value of that property. So when they inherit the property, the basis is determined at the time that you pass away, and that's the new fair market or that's the new basis, is the fair market value of that property at that time. So they can then, if they want to turn around and sell the property, they'd have zero to no tax, or very low to no tax liability if they did it shortly after your death, versus the tax liability being given to them when you give somebody a property. So it's a big difference, and it can be a life changer for people.
Yeah, absolutely. I'm glad you brought up the step up basis, because there's this concept that I've heard thrown around. Some people call it swap till you drop. That's
Yeah.
a way to continuously build wealth without having to pay a significant amount of taxes on your properties and real estate.
That's true. So you can exchange as often as you like. You could have multiple exchanges going on at the same time. Um, and I guess the best way to use a 1031 exchange would be start early, exchange, 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 swap, swap, swap
Hmm.
until you pass away, right?
Right.
And then your heirs inherit that property, and then they have no tax liability if they're to turn around and sell it. Or if they wanted to continue to exchange, they could continue to exchange. Let's say they're doctors or lawyers, or they're making really good income and they need something that they can start taking depreciation on. Well, right now you can still do that, right? So going forward, it's a multi-generational wealth building tool if you could look at it that way.
And you brought up an interesting point. I work with a lot of clients who have been in their primary residence for 5 years, 6 years, 10 years even, and saw a huge amount of equity grow in 2020 and 2021.
Mm-hmm.
Now, I know there's exemptions for your primary residence, right? And I think currently it's 250,000 for single and 500,000 for married couples, right?
That's correct. Yeah.
If we were to go beyond that on our primary residence, could we effectively use a 1031 exchange?
Unfortunately, no. 1031 is strictly for property that's held for investment or productive use in a trade or business. Now, when I get back to my farm and ranch, because we're in Texas and we do in Oklahoma, we do a lot of that. There's often folks that live on their ranch, right? They can combine their Section 121, which is what you're just talking about, with a 1031. So you're going to usually you will carve out the value of the house and 2 acres or 5 acres around it, assign that value according to a comparative market analysis of a house and 5 acres in that area. And you would exclude that from your 1031 exchange and then exchange the remaining acreage. So you're doing a combination of the two. So you could exchange that acreage for other acreage, right? Or you could go into red houses, retail, office, industrial, warehouse, apartment buildings, you name it.
That's where I think a lot of our viewers might be in their journey, right? Maybe they're on their first investment, maybe second investment property, and they're looking at their tax situation grow more and more complicated.
Right.
So,
Yeah, and 1031 exchange can be used to also ameliorate some of that tax liability from hitting you all at once. So in your example earlier where somebody might be buying several properties, for example,
right.
Let's say you have a property with a very low basis and you want to exchange it into several properties. Well, then you could gradually sell off those properties, not taking the tax hit in 1 year if you didn't want to continue to exchange. Right? So you're not getting that big tax hit at once. You're just paying taxes as properties sell over time. Or, ideally you would just exchange, but that's not for everybody.
Right. I've had the question come up previously. After I complete my 1031 exchange, say I purchase a property in all cash using the exchange funds. Can I then turn around the next month or 2 months after and do a cash out loan to get that capital out and use towards the next project?
That is possible. That would be under the advisement of your tax advisor or CPA. It used to be that the IRS could consider that tax avoidance by, just refinancing shortly after an exchange. It's one of those things, it's hard to predict how the IRS will perceive it in the future. I always err, again, on the side of caution. If you want to be really conservative, you wouldn't refinance for a couple of years.
Right.
But people are doing it in shorter periods of time, but we don't know what the outcome from that will be, right? And who's to say that the IRS won't take a stance in, a year or two and say, well, you can't do that,
Yeah.
However, right now we're seeing people refinance shortly after an exchange we haven't at least heard of any consequences from it.
Yeah. Interesting. So I know on our side, from the lens of a mortgage producer, there is very little time frame that's required as far as ownership. We call it ownership seasoning. We can do cash out loans really day 2, day 3 after you purchase the home, right? And that's a very common concern because you just went through all of this effort to do a 1031 exchange, and now you're seeing $300,000 and $400,000 of potential assets to use towards the next project that's just sitting in this home.
Right. Yeah, and it's tempting, right? So it's really up to the risk tolerance of the exchanger, but for most, if let's say it's for a valid business reason, right? So you're pulling that money out to do something else for your business.
Right.
That helps, right? But again, it's kind of a gray area. There's a lot of gray areas with 1031, right? So that's where you want to get a tax advisor involved, like a CPA that's knowledgeable about 1031 or an attorney that's very knowledgeable about 1031 to give you guidance on stuff like that. But I see people that are doing it, and I haven't seen any adverse, outcomes from it, but it's just hard to say what will happen.
Awesome. So then we're getting into 1031 exchanges 201, right? This is the sophomore class, right?
Yeah. So there's a couple of topics that we've hit on that are more like 201, like reverse and build-to-suit exchanges, and then some of the nuances of the tax law and what outcomes can come from your actions, right? So You just want to be, get as much advice as you can outside of your QI. It's funny, as a QI, we're not allowed to give tax or legal advice.
Mm-hmm.
We can talk about 1031 and point out issues that might be, something that you want to have somebody from outside give you assistance with.
Mm-hmm.
But I can't say, you can't do that or you can do that.
Right. Yeah, and mortgage brokers are in the same space, right? We have a ton of experience and the relationships, obviously, with different lines of business, but we're very compliant in what we say we can and cannot do.
Absolutely, yeah, yeah.
Right. My standard line is, "That's a fantastic question for your CPA."
Yeah, and, I'm sure that people are like, well, I'm sure you've heard this question before, but it doesn't change the fact that I can't answer it.
Right. Absolutely.
Yeah.
Absolutely. So, closing thoughts, any concepts, anything you want to leave our viewers with?
Oh gosh, just if you have questions, you can always reach out to me. I'm sure my phone number is going to be along somewhere, and that's the best.
Yes.
I'm pretty much available. Like David, if I'm awake. So after hours, weekends, holidays,
Absolutely.
you need somebody to call. And the nature of what I do is so time sensitive that I kind of have to be available.
Yep, absolutely. Well, for the viewers, what's the best way to reach out to you?
Either call me at 972-310-4127, or you can email me at patrick.noonan@ipx1031.com.
Fantastic. Patrick, it is an absolute pleasure to have you here. Thank you so much for making the time for us. And for our viewers, Patrick is here as a resource for you, as am I. We'll see you on the next one.